Hello, my name is Ruslan Zaika, and I am glad to welcome you to the first lesson of Alton Academy, your guide to the world of cryptocurrencies and Web3. Today we will start with the origins, learn how and why Bitcoin appeared, what caused its creation, and how the technologies behind it sparked the creation of a whole new world. Let's dive in. 2008. The world is experiencing one of the largest financial crises in history. Banks are going bankrupt. Millions of people are losing their savings. Markets are collapsing. Why did this happen? It all started with an overheated real estate market and unstable loans that banks were issuing left and right. In the early 2000s, the real estate market in the US was booming, and banks began to issue mortgage loans to everyone, including people with low creditworthiness. This meant that many received loans they could not repay. Moreover, banks created complex financial products such as mortgage-backed securities and sold them on the market, hiding the true risks. But the market cannot grow forever. In 2006, housing prices began to fall, and thousands of people faced the reality that their homes were worth less than they had paid. People could not pay their loans, which triggered a wave of bankruptcies and defaults. Like a snowball, this hit banks and investment firms. The situation peaked in September 2008 when the major investment bank Lehman Brothers filed for bankruptcy. This became a symbol of the beginning of the global financial crisis. Banks around the world faced a shortage of funds and trust in the financial system collapsed. For more context, you can watch the decent movie The Big Short at your leisure. These events are depicted quite well there. All these events led to a global recession. Millions of people lost their jobs, and many families lost their homes. The government poured billions of dollars to save the banks, but for many, this became proof of injustice. The banks were saved at the expense of taxpayers, while ordinary citizens were left without assistance. And against this backdrop of chaos, someone appeared under the pseudonym Satoshi Nakamoto. No one knew who he was. A loner, a group of developers, or just a brilliant programmer. On October 31st, 2008, he published a document titled Bitcoin, a peer-to-peer electronic cash system, where he described a new financial system called Bitcoin. Bitcoin is not just a new currency. It was an attempt to create a financial system where there are no intermediaries, where banks and regulators are not needed. Each transaction is conducted directly between users without the involvement of third parties. This is a decentralized system that is not subject to inflation or political manipulation. It was the 2008 crisis that became the catalyst for the creation of Bitcoin. People were looking for a way to manage their money themselves, without the fear that someone would lose it or devalue it. Someone proposed a solution, a cryptocurrency that no one can control except the users themselves. It belongs to no one, and at the same time belongs to everyone. Anyone can participate, but no one can control or change the rules at their discretion. Why did Bitcoin cause such a stir? Because it solved several problems at once. Firstly, it is not controlled by banks or governments. Secondly, transactions occur directly from one person to another without intermediaries. This means lower fees and no delays. And thirdly, Bitcoin is limited. Only 21 million coins will ever be created. This makes it truly rare and protects against inflation. People often compare Bitcoin to gold. But why? It's because, like gold, it is limited in quantity and protected from devaluation. This makes it a reliable asset for storing one's funds. Bitcoin became the world's first cryptocurrency to offer a new model of money. Open, transparent, and secure. And although it was not taken seriously at first, today it has changed not only the financial system, but also our understanding of what money is. Now let's take a look at the main technology on which Bitcoin is built. It is blockchain. Many have heard this word, but not everyone understands what it means. So, what is blockchain? In simple terms, it is a large decentralized database that records all transactions. Imagine a chain of blocks, each containing records of transactions, for example, who transferred bitcoins to whom. These blocks are linked together, and each new block is added on top of the previous ones. The main point is that each block cannot be altered once it has been added. This makes the blockchain incredibly reliable. Imagine a book where each page is a block containing information about transactions. This book is stored simultaneously on thousands of computers. You cannot tear out a page or rewrite it. Everyone will see it. That is why Bitcoin is so reliable. What is mining and how does it work? We already know that the blockchain consists of blocks, each of which stores a transaction. But how are new blocks created? There is a process called mining for this. It is a process where computers around the world compete to add a new block of data to the blockchain. But it's not easy, and to create a block, computers solve complex mathematical problems. The one who solves the problem first adds the new block and receives a reward. This process ensures the reliability and security of the network, as solving the problem requires significant computational resources. But this is just one way the blockchain works. Different networks use different principles for mining currency. For example, Bitcoin mining is built on the proof-of-work algorithm. Essentially, it involves finding a random number called a nonce. Miners, participants in the network, go through thousands and millions of numbers to find the correct solution, which produces a hash, a unique string that starts with a certain number of zeros. Only when this hash is found can the block be added to the blockchain. To understand it more easily, imagine that you need to solve a puzzle. It takes a lot of time to solve it. But when the puzzle is assembled, you immediately see that everything is done correctly. Proof of work works in a similar way. Finding the solution is difficult, but verifying it is easy. As soon as one of the miners finds the answer, other participants in the network can quickly verify and confirm it. And when the miner finds the suitable solution, the rest of the network verifies their work. If everything is correct, the new block is added to the blockchain. For this, the miner receives a reward, for example, in bitcoins. Proof of work makes the blockchain reliable and secure. If someone tries to alter the data in a block, they will have to recalculate all the blocks starting from the altered one, which will require colossal computational power. This is why such a system is practically impossible to hack. Proof of work is reliable but requires a lot of energy and resources. Therefore, over time, other consensus algorithms began to be developed, for example, proof of stake or proof of stake. This is a more energy-efficient alternative to proof of work and is increasingly used in the blockchain world. Unlike proof of work, where miners solve complex tasks, here the computational power is not important, but the size of your stake in the network, that is, the number of coins you hold. The more coins you have, the higher the chance that you will be able to create the next block and receive the reward. Imagine it this way: we have a group of participants, and each has invested a different amount of coins into the common network. The larger your stake, the greater your chances of being chosen to create the next block. This is similar to a lottery, but tickets are purchased with coins. The more coins you have, the more tickets you get. Like proof of work, proof of stake ensures the security of the network, but in a slightly different way. If someone wants to attack the network, they will need to hold a significant share of coins, which means they risk losing them if their actions are detected and blocked by the network. Proof of stake is an efficient, secure, and eco-friendly way to maintain the blockchain. It requires less energy and simplifies participation in the network. That is why many major blockchains, such as Ethereum, have transitioned to proof of stake. These are the two main consensus algorithms. In some networks, such as Solana, the proof of history algorithm is used. It utilizes the chronology of events to speed up the blockchain. Sequence is important here. In the timeline sequence, each transaction receives a timestamp indicating when it occurred, which helps the network process data faster since the sequence is already known. There is also proof of authority, an algorithm where the blockchain is managed by trusted participants called validators. Unlike other methods, it does not require significant computational power. Only verified individuals can add blocks, making the network operate faster and more reliably. All these consensus algorithms are different approaches to solving the same problem. How to make blockchain reliable, decentralized, and efficient. Depending on the goals and tasks of the network, different methods are chosen, but the essence is always the same: data, protection, and maintaining decentralization. But blockchain is not just about cryptocurrencies. This technology is finding applications in various fields, from finance and medicine to logistics and even elections. With blockchain, it is possible to securely store and verify any data, whether it is bank transactions, medical histories, or supply chains. The principle is the same. Identical data is stored on different computers and verified when changes occur. And in case of a discrepancy, whether you like it or not, You will have to reach a consensus. Here, either everyone else is wrong, which is unlikely, or the unmodified data is incorrect, which is more likely. And then everything is simple. A check is conducted and only one option remains. For example, in logistics, blockchain can be used to track the path of goods from the manufacturer to the store. In medicine, to store medical history and have access to it in any hospital. In elections, to be used for recording votes that cannot be changed or deleted. Well, we will talk about art in blockchain in a separate video that will concern NFTs. But, briefly, creators can confirm their authorship and sell the original work, receiving a percentage from each resale. Now imagine how many more opportunities this technology opens up. Think about what our society would look like if all data were recorded, transparent, and secure. This is the future we are moving towards with Web3 and decentralization. As this technology is already changing our world, opening new opportunities in various fields. What do you think? In what other areas can blockchain be applied? And how can it affect our daily lives? Write in the comments. Today we took the first step into the world of blockchain, cryptocurrencies, and Web3. We learned how and why cryptocurrency emerged. What is blockchain and how does it work? We also got acquainted with the possibilities of this technology beyond crypto. This is just the beginning. In the next lessons, we will delve into the world of cryptocurrencies. We will learn about Ethereum, smart contracts, Web3, DeFi, and much more. But everything in due time. Thank you for taking this step with us. Subscribe to Alton Academy, take tests in the Alton Trader app, ask questions, and share your thoughts in the comments. There is still a lot of interesting things ahead. This was Ruslan. See you soon in the next lesson.